Warren Buffett once said, "The Intelligent Investor is the best book on investing ever written." He even admitted that reading it at 19 changed his life completely. When I read it, it did the same for me, not because it gave me some magic formula to get rich, but because it taught me how to think about money, investing, and risk in a way that actually builds wealth. So today, I'm breaking down the 5 biggest takeaways from this classic, the ones that can save you from painful mistakes, protect your money, and help you invest intelligently for life. Takeaway number 1. Mr. Market, imagine you own a small coffee shop. Every morning, your eccentric neighbor, let's call him Mr. Market, barges in with a new offer. Day 1, I'll give you $1 million for this place. Next day, coffee's dead. I'll give you $50,000. Day after, changed my mind. $700,000. Would you take him seriously? Of course not. But in the stock market, people listen to Mr. Market every day. When prices rise, they rush to buy. When prices drop, they panic sell. Benjamin Graham's point. Mr. Market is emotional, irrational, and often wrong. Your job is not to let his mood dictate your moves. Instead, use his mood swings to your advantage. When he's panicking, quality stocks go on sale. When he's euphoric, prices may be too high. The key: the market is there to serve you, not instruct you. Takeaway number 2. Stop speculating. Investing is not the same as gambling. Investing is like buying a home you actually plan to live in. You research it, you know the neighborhood, and you buy it for long-term value. Speculating, that's buying a house just because someone told you it'll go to the moon. In the late 90s .com bubble, people threw money at any company with .com in the name. No profits, no plan. It ended in disaster because they weren't investing, they were betting. Golden rule: treat every stock as if you're buying the entire business. If you wouldn't own the whole thing, don't buy even a tiny piece. Takeaway number 3. Margin of safety. Even if your research is flawless, things can still go wrong. If a company is worth $50 a share, don't pay $50. Wait until it's $30 or less. That gap is your margin of safety, your buffer against the unknown. In 2008, great companies like Coca-Cola and Johnson & Johnson were trading far below their value. Buffett bought big, not because he guessed the future, but because he had a massive safety margin. Lesson: a great business at the wrong price is still a bad deal. Wait for the right price. Patience pays. Takeaway number 4. Pick a side. You're either defensive investor, low maintenance, you buy index funds, invest consistently, and let compounding work. Enterprising investor, hands-on, you study businesses, hunt for undervalued stocks, and put in serious research hours. Both approaches work, but the middle ground, half research, half trend chasing, is where people lose money. Decide who you are and stick with it. Takeaway number 5. Emotional discipline. Your emotions can destroy your portfolio faster than a bad stock pick. When the market dips, fear makes people sell. When it skyrockets, greed makes them overpay. Graham's advice: have a system, dollar cost average, rebalance periodically, ignore short-term noise. Like a pilot flying through turbulence, stick to your flight plan. These 5 ideas work best together. Treat stocks like real businesses. Keep a margin of safety. Let Mr. Market's mood work for you. Choose your investing style and commit. Master your emotions. Do that, and you'll protect your wealth. Grow it steadily, and avoid the traps that destroy most investors.